Welcome back to the Wall Street Podcast. Today we're doing a deep dive into some real tensions we're seeing in Federal Reserve policy, specifically looking at statements from Tuesday, September 23rd, 2025. These are really framing market sentiment right now.
That's right. And what jumps out immediately is this, well, fundamental disagreement between Atlanta Fed President Raphael Bostic and Fed Governor Stephen Miran. They have just wildly different takes on the neutral rate and, crucially, whether we need more rate cuts right now.
Okay, let's start with Bostic. He sounds pretty cautious, doesn't he? Very hesitant about another cut in October.
Extremely hesitant, yeah. For him, it's still all about inflation. He's projecting core inflation to hang around, what, 3.1% by the end of the year?
And he doesn't see that 2% target being hit until 2028. That's a long way off.
It really is. And he's pointing to specific risks driving that view. Not just the usual economic factors. He talks about higher prices from tariffs, sure, but also slower growth. And here's a key bit. He links limits on labor force growth tied to immigration restrictions directly to the hiring slowdown. So it explains about a third of it.
Wait, so he's actually quantifying the impact of non-monetary policy, saying immigration rules are a measurable drag affecting inflation forecasts.
That seems to be the implication. It definitely makes the Fed's job more complex. Yeah.
Definitely. Okay, so contrast that with Miran. What's his argument?
Miran's coming from a very different place. Remember, he pushed for a bigger cut last week. He believes recent policy changes have already pushed down the theoretical neutral rate quite significantly.
The rate that doesn't stimulate or slow things down.
Exactly. And he thinks the appropriate Fed funds rate should actually be down in the mid-2% range.
Mid-twos. We're currently at 4 to 4.25%. That's nearly 2 full percentage points lower.
It's a massive gap in perspective, isn't it?
Huge. So if Bostic thinks money needs to stay expensive, how does that square with, well, the enormous AI investments we saw this week? Is big tech just ignoring the Fed?
It certainly looks like they're playing a longer game. Take Nvidia, planning to pour up to $100 billion into OpenAI for data centers. That plus Oracle's, what, $300 billion deal with OpenAI? It signals massive strategic confidence in AI's future, almost irrespective of near-term rates.
They're betting big on transformation, cost of capital aside.
Seems that way. It's about securing that future dominance.
And speaking of strategic moves, we also saw major M&A. Pfizer buying Metsera for up to $7.3 billion. Compass getting Anywhere Real Estate for $1.6 billion. Are these players looking past rate volatility too?
I think so, yes. These deals show clear strategic thinking in different market conditions. Compass buying Anywhere, that's classic consolidation in a softer market, like real estate brokerage.
Makes sense. Get bigger, find efficiencies.
Right. Then you have Pfizer going hard after Metsera. That's about jumping back into a massive growth area, obesity drugs, by buying up a clinical pipeline.
So, aggressive growth plays on one hand, consolidation on the other. Both suggest a focus beyond the next Fed meeting.
Precisely. These are bets calculated over years, not months.
Okay, but with all this focus on growth and AI, we have Mark Spitznagel, the crash guy, out there drawing parallels to 1929. How does this Fed debate feed into his, well, rather extreme view?
Well, Spitznagel's core warning is that all the past federal rescues have just piled up dry tinder, as he calls it, for a big correction down the line. And here's the kicker. He thinks the very rate cuts Miran is arguing for could be the catalyst. Not for the crash itself, but for a final rapid push higher first, maybe S&P 8,000.
So a blow-off-top scenario.
He's pointing to that historical pattern. Yeah, big rallies often precede the biggest falls. It's a stark counter-narrative to the current excitement.
Let's bring this down to the real-world impact for a moment. You mentioned Pfizer and the obesity drug space. We're seeing that race heat up everywhere, right?
Absolutely. Look at Novo Nordisk filing for FDA approval for a daily weight loss pill. That could launch by early 2026. Eli Lilly, Roche, they're all pushing hard, too.
So the M&A translates pretty directly into more accessible options for consumers, moving beyond just injectables.
Yeah, exactly. It signals a huge shift towards making these treatments mainstream, potentially impacting millions of people and mass amounts of healthcare spending.
So wrapping this up, what's the key tension for our listeners to track?
I think it boils down to this. The disconnect isn't just about the next rate cut. It's this widening chasm between the market's current enthusiasm, chasing S&P 8,000, fueled by AI and deal-making, and the Fed's own official line. Remember, Bostic saying 2% inflation isn't likely until 2028. So the question for you is, what does this divergence between short-term market euphoria and the Fed's long-term caution actually imply for how you should be allocating capital right now?